All right, so this is the fun part where we're going to try to put everything together that you've been learning about and do some assessments on some different companies. So this first video that I'm going to do is going to be a company that I think is going to surprise a lot of people that we're choosing here, and it's Tesla Motor Company, Elon Musk's company. And the reason that we're picking this is because a lot of people in the value investing community don't necessarily understand that you can still value growth picks, and you can kind of go about it and try to understand what the value might be. And so that's why I'm picking this first one. And in the end, you're going to see that it's probably a very poor choice to invest in, but the process that I'm going to be going through is what's really important here for you to understand. So let me just hit on this idea of growth versus value. So in 1992, Warren Buffett wrote in his shareholder letters, he wrote this quote here: "Most analysts feel they must choose between two approaches customarily thought to be in opposition, and the opposition was value versus growth. Indeed, many investment professionals see any mix of the two terms as a form of intellectual cross-dressing. Buffett says, we view that as fuzzy thinking in which, it must be confessed, I myself engaged in some years ago. In our opinion, the two approaches are joint at the hip. Growth is almost a component in the calculation of value, constituting a variable can be ranged from negligible to erroneous and whose impact can be negative as well as positive." So that's his way of saying you can still value a growth company. And you know what? You might still get decent results, whether it's something that has a decent intrinsic value at the current price. So let's go through Tesla and give this a try to see if it might be a growth company that's worth buying. So the first thing that I do whenever I come to any company is I just do kind of a overarching overview to know what I'm dealing with. So I'm going to use Morningstar here as the example. You could use any type of analytics website. So the first thing I see when I come to Tesla is that the price for one share is $356. So whenever I see that price, my immediate thought, or at least the way I think through things, is if I was going to get a 10% return on this company, I would expect the earnings or the bottom line profit to be around $35 if I was going to get a 10% return. If I wanted to get about a 3% return, which is where the market in the summer of 2017 is currently priced, it's at a PE of 30, which means to me that I'm going to get a rough amount of about a 3% return by being in the S&P 500. So if that was true, that means that the earnings on this company should be about $10 per share. The profit that one share produces should be about $10 to give me about a 3% return. But what you're going to find with this specific company is that the earnings are not even there. They're actually negative earnings. So what you're going to do, what I do is I go to the key ratio tab because it's a nice overview for me to see 10 years worth of data, and I can see all this stuff all in one snapshot. So the top line, okay, this is the money that's flowing into the business before any expenses and anything subtracted out of it. So we can quickly see that at the end of 2016, Elon Musk's Tesla was making $7 billion in top-line revenue flowing into the business, $7 billion. But as you go down to the bottom line figure, which is the net income, you can see that although they received $7 billion worth of money from the sale of their cars, the solar stuff's wrapped into this now, what's left is a negative $675 million. Now, when we look at the history, and that's why I like going to this key ratios tab, is because I can see what the trend has been over the last 10 years. So the previous year, he made $4 billion in the top line, and his bottom line was even worse. It was negative $889 million. So you can see this trend. And you can see that one of the most notable trends here is his top line. And his top line is growing like crazy. It's almost doubling every year. That is a very good thing. But when you look at the net income, you can see that it is also growing in the negative direction, which shows that they've got a lot of work ahead of them in order to turn this into a business that's going to become profitable. Okay, so that's kind of where we start. That's where we might think about the business and that they've got a real challenge on their hands. So my next thing would be, how much debt are they accruing? Because when you look at this net income that's negative and it's growing, I want to know how much debt they're taking on and whether that's at a manageable level. So the first thing that I think of whenever I would see something like that is let's go ahead and check out the cash flow statement to see how they're paying for this debt, because they have to be taking on debt with all these negative numbers. How are they paying for that? How are they financing things? And how much of it is there? So the next tab I'll click on is the Financials tab. And then I click on the cash flow statement. So once I arrive at the cash flow statement, the way you got to think of this is just really in three categories. So the top category here is going to show you all the money that's coming into the business from the operations, from them selling cars, from them doing the things that the business does. And this is where we can still see, even though this is adjusted to make it all cash items, bottom line is listed first on the cash flow statement, and then it's adjusted for all cash items. So at the end, you can see the cash flow that's coming through the business is negative. Then when you look down here at their investments, so all these blocks here from the gray one up, these are all the investments that they're making. They're making huge investments into their property, plant, and equipment, which is their gigafactory and all that kind of stuff. So when you look at that, the huge negative numbers, when they're in the parentheses, that means they're negative numbers. And so then these two are added together to show how substantial. You're going to look at the operational line, you're going to look at the investing line, and then you're going to figure out how are they able to sustain this business if there's so much negative dollars flowing out of the business. And so when you go into the last column here, which is from here to here, what that is covering is how they're financing everything. And when you look at this, see the positive number right here? That means that they had brought in $2.8 billion of cash through issuance of debt. They also repaid $1.9 billion of debt, which was probably at a higher interest rate. So that's probably why that happened. So they kind of did a refi on the house here. So whenever you look at this, they raised $1.7 billion by issuing more stock. So if you currently owned the business before that took place, Elon Musk, he diluted your share of the business by issuing even more stock. It's kind of like the Federal Reserve model here. He's devaluing your shares and diluting the value of them by issuing more, and he raised $1.7 billion by doing that. And then there's all these other financing activities where he's raising money. And so you can see there's a positive cash flow of $3.7 billion coming into the business, turning into cash because of these fundraising activities. And so when you look at what he's spending, so he spent 1.4 and he spent 100 million here, but he raised 3.7 billion in cash, and he did most of that through issuing more debt and issuing more shares. So now we can kind of understand how he's able to keep the boat afloat, and he's doing it through these activities. Now, as he goes longer and longer without being profitable, it's going to get harder and harder for him to raise money through debt at low interest rates, and it's going to be harder for him to convince shareholders to keep that price propped up if he has to dilute the shares in order to raise money. So that's something you got to think about when you would be considering owning this, is if he runs into operational issues, he's not able to produce as many cars. All of those things are going to play out, and they're going to have an impact on his ability to raise more money. And remember, if he's raising more debt each time in order to keep this thing going, the more money that he raises, the more precarious the business becomes, the higher interest rate the market will demand from his debt that he's issuing. So that's important, which then has a compounding impact as he continues to not be able to be profitable moving forward, potentially. Okay, so with all that stuff said, let's go to our checklist and our sheet and start going through this, and I'll just go through my thought process with you so you can kind of see how I would start to try to value this thing. So when we go to our checklist, there's tabs at the bottom. This is our intrinsic value calculator that you would have learned about in one of the previous lessons from the other module. And then this is our competitive advantage checklist. Anywhere that's yellow is where you can input information. Let's type in the company name here. This is Tesla. Now, the first thing I like to do is I like to try to understand where the business is making their money. When you look at Tesla, so we all know that Tesla sells cars. We know that Tesla also has this energy arm where they're selling solar type things. They've got all this stuff wrapped inside the business. But until you actually know where the money's being made, it's kind of pointless for you to do research on energy if energy is not something that's actually adding a lot of revenue to the business. So what I like to do is try to understand that mix. I try to understand the portfolio of the company. So whenever I do all this research of stickiness, cash position, patents, threat of new entrants, all that's a lot of work. I mean, a lot of work on the qualitative side. That if, let's say that his solar piece is only 5% of his overall revenues coming into the business, I'm not going to spend a lot of time doing research there because it's just not worth my effort. So that's why I like to go through and understand what are the assets that are actually bringing revenues into the business. So let's go ahead and do that assessment. So first thing I'm going to recommend is you go to Google and you just type in Tesla 10Q. And what you're going to get is you're going to get a bunch of different results here. And then you can see SEC filings, Tesla Motors. And this is stuff that you really can't pull off of Morningstar. Now, they do have the 10Qs and stuff on Morningstar. I'm just showing you, I guess, an easier way for me to find it. And there's the last 10Q, 4th of August, 2017. I'm going to click on that, and it's going to open it up. And these things are very boring for a lot of people to read unless you really start to catch on to this stuff and start to enjoy it. So it looks very legal-like, not something that you would pick up for pleasure. But what I'll tell you is there's so much information in here that's going to help you dissect the business. So once you start getting comfortable with these, they're not so scary after all. So go to the consolidated statement of operations for Tesla. And once we get here, we can see that their revenues, which is their top line, is broken down into more fidelity. Okay, so when we are looking at the revenues, let's go back to Morningstar here. When we're at Morningstar and we go to the financials and you look at the income statement, all it says is revenue. It doesn't tell you, see all the revenue here, and this is in quarterly data. Let me put it in annual so it all makes sense. So there's that 7,000 or 7 billion that we saw earlier. And you can see how it doesn't break out that revenue. So you don't know what assets are actually producing that revenue. So that's why I'm pulling up the 10K, just so you understand why I was doing that. So as we go back to the 10K, and it's right here, you can see that on the 10Q, which is the quarterly, the 10K is the annual. When you look at the 10Q, it's going to show you that the breakout of these revenues. So what I'm going to do is I'm just going to list these into my sheet here. And in red, I said, note, keep all numbers in quarterly figures, because as we go down here and we look at some competitors, we want to compare apples to apples. So the total revenue for the quarter, when we look at this, is 2.7 billion. So I'm just going to take this number right here, and I'm going to go ahead and paste that into the total revenue. And that's kind of our baseline so that we know what the total number is compared to everything else. When we go back here, we see automotive sales. So we'll take that and we'll put that as the first asset, automotive sales. What we want to know is what's that figure that the automotive sales are. So when we look at that, it's 2 billion, which is a huge number. So we automatically know that $2 billion of the 2.7 comes from his automotive sales. Now, another number here is the automotive leasing. So let's go ahead and list that. Automotive leasing. And that number is 272,764,000. So now we're starting to see the breakout here. 72% of all his revenue is coming from his automotive sales. 9% of his revenues is coming from automotive leasing. Let's go back here and look. So now he has energy generation and storage. And so I'm sure a lot of people have read about this in the news, and you can see that the number is 286 million. So let's just put in here energy, and you could list out the whole thing if you wanted, but it's 286,780. And so that's 10%. Okay, now we're getting an even better picture of what's going on with this company. And then the last thing that he has is services and other. So let's just put down services. And that comes out to be 216 million. So all those numbers sound really big. In fact, if you were reading a article that said, "Oh yeah, Elon Musk's energy, division made $286 million this past year," and a person would read that and it has no you're not able to actually define how big that number is unless you compare it to the overall revenue and where it sits inside of his company. So when we look at this, we can see that his energy is really a very small level of his business. It's only 10%. The services are 7%. His automotive, though, is almost making up 80% of the business. So if we're going to think about the competitive advantage moving forward, when we're doing these assessments, it's going to be very centric on the automotive sales. Now, I will add in a caveat. Now, if there's a lot of information out there that you're reading that the energy is where his big push is, he plans on taking, quadrupling his revenues and energy in the next 2 years or whatever the amount might be, then you might want to take a closer look at that if you're expecting the trend to increase. But in general, when you're looking at this, most of my focus and most of my energy would be spent understanding his automotive sales. So when you think about this and you're saying, okay, so where's that going to go into the future? What do these numbers look like moving forward? That's going to be a very important part of your analysis, because when we're doing our intrinsic value, remember, it's all about what it's going to make into the future. Something else that I added here is a competitor tab so that you can kind of understand how big Tesla is compared to other businesses. So let's just go ahead and I'll demo this real fast. So you can type in General Motors. And let's go ahead and pull up the information for General Motors. We'll go back to Morningstar to get this information. Let me close that out. Okay, we'll go back to Morningstar, GM, General Motors. We pull that up, and remember, we want this information to be in quarterly data so that it matches the quarterly data that we just entered for Tesla. Okay, and so once we have the quarterly data in here, and we're going to pull up the income statement, and it's still quarterly data, we can see that the revenue for General Motors was $36 billion in the last quarter of 2017. So we'll put down $36.9 billion here. Competitor revenue, 36,900. All right, so when we put this number in, this number is not correct because we got to add a couple more zeros to it, because the numbers that we were using for Tesla were in thousands, and the numbers that we're using in GM were in millions. So we've got to add 3 more zeros, and now we've got an accurate assessment that is automatically populated here. It says Tesla is 7% times the size of GM with respect to its revenue. So maybe on the internet you saw that Tesla is bigger than GM and all that. That's the market cap. That's what the market is valuing the business, that it's valuing it higher than GM. But when you really look at it from an operational standpoint, which is the way I like to look at it, you can see that Tesla is basically selling 7% of the revenue, which is the top line, the money actually flowing into the business. It's only 7% of a company like GM. And it's being valued at the same level, which can already tell you where our intrinsic value is probably going to be going here. So let's go ahead and look at the competitor's net income. So you go down to the bottom line here, net income, $1.6 billion. So we're just going to put 1,600,000, enter. All right, and once we put the net income in there, you can see that it populated our competitor's margin. So GM did about a 4% margin. For every $100 that came into GM, that came into their top line, at the bottom line, the amount that they're banking is $4 for every $100 that they make. So assuming that Tesla could actually do something similar with their revenue, we could figure out how much cash flow or net income the business could potentially be making if they became profitable, assuming they'd have a same margin, which I think would be a reasonable assessment moving forward. So instead of going through all these competitive advantages, I'm going to save the time because I can already see the direction that this is heading. And the direction that this is heading is not in a good one, because this company is going to be way overvalued, extremely overvalued, even if we assume massive growth rates on their revenue and all sorts of things, and that they bring it in and they're profitable and everything else. I think that it's going to be extremely overvalued. So I'm not going to spend a lot of time doing all this qualitative work and research and studying to understand all these qualitative factors. Instead, what I'm going to do is I'm going to go over to the intrinsic value line, and I'm going to start filling this thing out because I think it's going to produce a negative return for me. So first thing that we could do when we're doing the intrinsic value calculation is that we're going to paste in the free cash flows. So when we go back to key ratios, and we're on General Motors here. Let me get up Tesla. Okay, and there's Tesla. And we go down to the free cash flow of the business. When you look at these numbers, they're all negative. Every one of the numbers for the free cash flow are negative. So if I take those and I paste them in, I am not going to be able to get any type of value here that's usable. So what I'm going to propose instead, and I'm really trying to make this work, and I'm really trying to prove to myself that this is not a good pick. And the way I'm going to do that is I'm going to make some assumptions. What I'm going to do is I'm going to take the top line of the business, okay, and I don't have 10 years of data. So I'm just going to take the 9 years of data. I'm going to copy those points, and I'm going to go ahead and paste them in. This is the first year. This is the second year. I'm going to paste those in there. And then I'm going to put 0 in for the year that it wasn't there. Okay, and I'll make all these yellow again. Now, once I put those numbers in, you can see that it's graphed automatically for me. But we got to remember, this is the top line. This is not the bottom line. This is not profit. We can't value the top line necessarily the same way that we would value the bottom line. So what I'm going to do is I'm going to make an assumption. I'm going to say that instead of the company being negative on their cash flow, I'm going to assume that in the future, they could actually produce a positive free cash flow. And if they are producing a positive free cash flow, it would be at, let's just say, 5%, 4% of their revenue or their top line. And that's what GM was doing. That's why we did that little assessment of what the competitors are able to do on margin for a car company. Now, his could maybe be a little bit higher because maybe he would bring in the energy thing. I don't know. But let's just say 5% would be a nice conservative estimate. So if we would do that, we'd take this number, okay, and I'm going to show you how to do this in Excel. You just hit equals 7,000, which is the top line revenue, but we're going to multiply that by 0.05, which would be 5% of that number, which means that for this 1 year that we just entered, we got $350 million as the free cash flow, potentially. And you're going to see why I'm doing this, because if I assume that the company could be operating at a 5% margin, what I can then do down here is I can then make a projection as to what that might look like moving forward. So instead of boring you by entering this number a whole bunch of times 0.05, we're just going to go ahead and skip ahead into the after I'd already entered all these, and then you can join me again after I enter all this. Okay, so now you're back with me after I had entered all those 0.05s times the top line revenue. And this is me making the assumption that the company could be profitable, and this is what their bottom line would look like if they could be profitable. And now what's fun is when we come down here and we're trying to make an estimate of what the future might look like, we can now start drawing our arrays. So if this could actually be free cash flow, which it's not, but let's just say that all of a sudden Tesla can start becoming profitable and their revenues are going to continue to grow, which, is what I fully expect to happen. What could that potential free cash flow look like moving into the next 10 years? Okay, so the top line there, the red one, we put 20%. That's what it looks like. If you think that's a little bit aggressive, we can move it to 15%. The most likely we put in there at 5%. And then the lower band, let's say they come on, economic recession. It starts to really tear them apart with all the debt and everything that they're taking on. They can't keep issuing all the shares because the stock price is getting punished, all that kind of stuff. 10, or we could even do negative 15%, and you can see what those arrays look like. Now, we've got to ask ourselves, what's the probability of each one of these arrays coming true? I would say that the most likely one, the middle one, has a very high probability if that would come true. So if that's 70%, let's say that my top one might be 20%, and then my bottom one might be 10%. Now, we've got a valid model because these add up to 100. And then we'll come down, and what it's doing is it's modeling what those free cash flows might look like, assuming Tesla could bring in a 5% margin off their top line. So now that we have those, let's go ahead and enter the rest of the information here and see what kind of value we get for the potential yield. So when we come down here, we've got to look at the number of shares that Tesla currently has. It's 144. It'll probably keep going up. But for right now, we'll just put 144. And then the current market price was like $370 or something. And once we put that in there, we see that the company is showing a negative 3% return. And this is assuming all of these things that could potentially happen, which are probably a long shot. And that just, for me, whenever I would see something like this, I immediately say, I've got to start looking in other places. And so the reason I really wanted you to see me go through this is because you can see how I saved myself a ton of time in research by going straight to the numbers after doing some of this initial modeling, initial kind of understanding like, hey, 70% or 80% of the business is all in the automotive sector. Looking at what a competitor's margin is, I can quickly go through and skip all this competitive advantage stuff because although they have a fantastic product, these cars are incredible, absolutely incredible cars. From a numbers standpoint, I think you'd be crazy to buy the company at today's price at $370. My expectation in 5 years from now is that the price is probably still going to be around $370 or less. So that's my assessment. That's how I would think through this particular growth company. You can use a similar approach for any other business that's growing like crazy that you might feel like, hey, I'm missing out on this thing. And, everyone's talking about Tesla. They've got a fantastic product. They've got a lot of growth potential to make more cars and all that kind of stuff. But at the end of the day, if the numbers don't make sense, the numbers don't make sense. You can't make something that's not there. So now if the price for Tesla was, say, $50, now all of a sudden I might expect a 6.5% return at a $50 price based on these growth expectations that I have. Now, one final thing that I will say, my model here keeps this price fixed for the next 5 years, and then that price decreases into the out years, which might not be the case for a new company like Tesla and a very, very intelligent founder who's probably one of the smartest people that'll ever live during our lifetime. So all that stuff has to be accounted for. You have to think through all that stuff, but at the same time, you have to be very conservative. And, Warren Buffett's number one rule, don't lose money. His second rule, refer back to rule number one. So when I'm thinking through this, I'm looking at it from a very defensive position, and I'm thinking about it very conservatively, and I'm not trying to put money into something that's going to be a losing proposition, even if this would come true. Let's do something real unique here before we stop. Let's just say that we have a ton of confidence in this upper band. Let's say that we have like 80% confidence in that upper band, and we have 10% here and 10% here for a valid model. Okay, so now it's valuing like a real high probability that that these free cash flows, which don't even exist, are going to continue to grow into the future at that insane rate. And when we do that, and you buy it for $50, you're only getting a 10% return. Let's put in the real price here at $370, and you can see it's still at a negative return. Okay, so that kind of wraps up my assessment. I hope you guys enjoyed how I went through this. And you got to realize every company that you go through is going to be slightly different. But the tools and the resources and the thought process of how I'm going through it is the important point for you to kind of understand. Remember, start really big picture. You want to kind of understand what's really important here. So whenever I first started, I started off, what's the price of the company? What kind of earnings is the company producing? The earnings were negative. So then it's like, let's see how they're generating cash. Where are they getting this from? What's sustainable? All that kind of stuff is really important for your thought process. So the next company that we're going to do in the next segment is Berkshire Hathaway, which is a very stable business, makes tons of money. And we're going to see what the value of that might be in the market in the summer of 2017.